You enter before the setup is complete, because waiting feels like missing money, and that single decision can turn a manageable trade into an emotional one. Price hesitates. You move the stop a little farther away. Then it pushes against you, and instead of accepting invalidation, you add to the position, because recovering quickly now feels more important than following the original plan. That is where the real conflict begins. The pressure is not only coming from the chart, it is coming from the time horizon you have chosen. When you expect progress to appear in days, every trade starts carrying too much responsibility. A small loss feels like falling behind. A missed move feels unacceptable. A quiet session feels wasted. The market does not respond to that urgency. It often punishes it. Consider a hypothetical trade. Price breaks above resistance, pulls back, but has not yet confirmed support. You enter early because the move might leave without you. It drops, you hesitate to exit, and now your attention shifts from reading price objectively to protecting the outcome you wanted. One rush decision has changed the next 3 decisions. Building wealth through trading is less connected to finding dramatic wins than it first appears. The more important question is what your behavior looks like across dozens of uncertain decisions when no single trade is allowed to define the month. The first chart will show exactly how an ordinary setup turns dangerous when the trader starts demanding a result too quickly. You can often see the problem before the trade even begins. A setup appears, and instead of asking whether the conditions are right, you ask what this trade could do for your week. That small shift matters. The moment one trade is given responsibility for your progress, your judgment changes. A normal loss no longer feels normal. A quiet day feels like delay. A position that takes time to develop begins to feel defective simply because your expectations are moving faster than price. The market has no obligation to match your personal schedule. If you expect visible progress every few days, you begin measuring yourself against noise. One red session feels important. 2 slow sessions feel like something must be fixed. Soon, the question is no longer whether your decisions are sound. The question becomes whether they are producing results quickly enough. That pressure is dangerous because it changes the meaning of ordinary outcomes. A hypothetical trade can be perfectly reasonable and still fail. Another can work immediately. Neither result, by itself, tells you much about what your process can produce over time. But when your horizon is too short, you treat each outcome as evidence about your entire ability. That is when consistency becomes difficult, not because the market suddenly changed, but because your standard for progress became too impatient. And once impatience enters the calendar, it begins creating another problem, the feeling that every trading day should contain a trade. There are sessions when the market gives you nothing clean. No clear structure, no convincing continuation. No reason to act beyond the fact that you are sitting there watching. That is where selectivity is tested. When you believe a productive trading day must include a position, inactivity starts to feel like failure. You study the chart longer, search smaller time frames, and gradually become willing to accept evidence you would have rejected an hour earlier. The setup has not improved. Your standard has weakened. Imagine a hypothetical session where price is trapped between 2 obvious levels. The first breakout fails. The second has no follow-through. By midday, you begin seeing patterns inside movement that was previously just noise. Why? Because the desire to participate has become stronger than the evidence required to participate. That creates a subtle reversal of responsibility. Instead of the market proving that a trade deserves your capital, you begin trying to prove that your day deserves a trade. There is a practical question worth asking before any entry. If you had already made one clean trade today, would this setup still look attractive? If the answer changes, the chart may not be making the decision. Waiting can feel passive because nothing appears on the P&L. But refusing weak exposure is still a decision with consequences. Capital that remains untouched is still available when conditions become clearer. The harder problem begins when you do take the questionable trade, and price starts showing you that the original idea may no longer be valid. A trade can become dangerous after the market has already answered the original question. Suppose, hypothetically, You buy because price holds above a level that should now act as support. Then price breaks back below it, closes there, and fails to recover. The condition that justified the trade is gone. Yet you remain. At that point, you are no longer managing the same idea. The mind begins searching for a new argument. Perhaps the breakdown is temporary. Perhaps buyers will return. Perhaps the next candle will repair the structure. Each new explanation delays one uncomfortable admission that the market has produced evidence against your original judgment. This is how a trading decision becomes personal. Once being wrong feels like a statement about your ability, you stop treating invalidation as information. You begin treating it as something to resist. Because you resist it, you reinterpret evidence. Because you reinterpret evidence, the position survives conditions it was never meant to survive. Ask yourself a precise question. If you had no position open, would the chart in front of you still justify entering in the same direction? That question separates the market you are observing from the trade you are defending. You do not need every idea to survive. You need to know when the reason for holding it has disappeared, but sometimes the resistance to that fact becomes much stronger than the thesis itself, and the reason is not always the chart. The chart can be identical, the setup can be identical, and yet your ability to think clearly can change completely because of one variable, how large the position is. With modest exposure, a normal pullback looks like normal movement. With excessive exposure, the same pullback suddenly feels urgent. You watch every tick. You check the position repeatedly. Small fluctuations begin demanding decisions they did not deserve a few minutes earlier. The market has not become more dangerous. Your exposure has changed your perception of it. This matters because size does more than change the amount at risk. It changes the quality of your attention. When the financial consequence of each movement becomes too important, observation turns into reaction. You stop seeing structure clearly because your mind is measuring discomfort instead. Consider a hypothetical trade moving sideways after entry, exactly where some hesitation would be reasonable. At one position size, you can let the market reveal what it is doing. At another, every small move against you feels like evidence that something must be done immediately. So before judging how disciplined you are under pressure, ask a harder question. Did you create more pressure than the trade required? A position should leave enough mental room for uncertainty to exist without forcing constant interference. And when that room disappears completely, the effect does not always end when the position is closed. The first trade is closed, but sometimes the loss remains active in your mind. You open the next chart carrying a number you want erased. Now the next setup has a second job. It is no longer only a question of whether the opportunity is sound. It has become a chance to get back what the market just took. That changes the decision before you notice it. Consider a hypothetical loss early in the session. 20 minutes later, another setup appears. Under normal conditions, you might study it calmly, but with the previous loss still fresh, every favorable candle feels more convincing because you are not only seeing opportunity, you are seeing relief. The danger is that recovery becomes the objective. Once that happens, patience with evidence becomes harder. You begin calculating how quickly the new trade could restore the account rather than judging the new situation on its own terms. A completely separate market event becomes emotionally connected to a trade that has already ended. Ask yourself, if the first loss had never happened, would you feel exactly the same urgency to take this position? That question exposes whether you are responding to current information or trying to repair the past. A closed trade should lose its authority over the next decision, but markets create another kind of unfinished business as well, especially when the opportunity you wanted moves away without you. Sometimes the best entry passes without you. Price reaches the level, reacts cleanly, and begins moving before you are ready. The first mistake is not missing it. The danger begins when you decide that being left behind is unacceptable. Consider a hypothetical breakout you plan to buy near 100. Price clears the level, accelerates to 104, and never gives the pullback you expected. At 100 you were evaluating structure. At 104 you are evaluating regret. That difference matters. As price moves farther away, The trade can feel more convincing because the movement itself appears to confirm your original idea. But the evidence and the opportunity are not the same thing. The direction may look clearer while the entry becomes less favorable. So the decision quietly changes. You are no longer asking whether this is still the trade you prepared for. You are asking whether you can tolerate watching it continue without you. That question can pull you into a position whose conditions you never intended to accept. A missed move has no financial consequence until you try to recover the opportunity after its original terms have disappeared. The market does not owe you another entry simply because your analysis was correct. And if you do manage to enter before the move is over, a different pressure appears the moment that late position starts showing a profit. A profitable trade creates a different kind of pressure. Once the position moves in your favor, the market may still look healthy, but your attention shifts from the chart to the gain, now sitting on the screen. That gain begins to feel owned. Consider a hypothetical trade that advances steadily, then pulls back slightly while the original structure remains intact. Before the profit appeared, that same pullback might have looked ordinary. After the profit appears, it can feel like something is being taken away from you. That feeling changes behavior. You tighten the stop without new evidence. You exit because the open profit has started shrinking. You begin managing the number instead of managing the position. The cause is simple. Once an unrealized gain becomes psychologically yours, normal fluctuation starts to feel like loss. Ask yourself a precise question. If you entered this position at the current price, with no knowledge of the profit already made, would the present market action still concern you? If the answer is no, then your discomfort may be coming from ownership, not from deterioration in the trade. A profitable position still contains uncertainty. It can reverse, continue, or stall. The difficulty is allowing new market information, not fear of surrendering something already gained, to determine what happens next. But even when a trader handles that well, another problem remains. A profitable outcome can make a poor decision look intelligent. A trade can make money and still teach you the wrong lesson. Suppose, hypothetically, you enter without the confirmation your plan required. Price moves in your favor anyway, and you finish the trade with a profit. The account rewards you, but the decision itself may still have been poor. That is where short-term results become misleading. If you judge the trade only by the money made, you may repeat the same behavior with greater confidence. The next time, the market may not be as forgiving. What looked like skill was partly luck, but profit can hide that distinction. The reverse is also true. A well-planned trade can lose because uncertainty is part of the business. If you treat every losing outcome as proof of a bad decision, you can start abandoning sound behavior simply because it did not pay immediately. So what exactly are you measuring? The useful question is not only, did this trade make money? It is, did I make the decision I intended to make for the reasons I intended to make it? That separates process from outcome. Without that separation, profit can reinforce carelessness and loss can punish discipline. Over time, the trader begins learning from noise instead of from behavior. And once poor decisions are repeatedly rewarded, the next danger is larger than a single bad trade. Eventually, one mistake can become expensive enough to threaten your ability to keep participating at all. A severe loss does more than reduce the account. It reduces the number of future decisions you are able to make from the same position of strength. That is why preservation matters. Consider a hypothetical account that suffers a deep drawdown from one oversized mistake. The damage is not limited to the money already lost. The remaining capital now has to work harder just to restore the old base, while every new decision carries greater pressure, because there is less room for error. The mathematics becomes less forgiving as the damage grows. If capital falls by half, a 50% gain does not restore it. The remaining half must double just to return to the starting point. That is not a prediction about what will happen. It is simply the arithmetic of loss. This changes the real question behind risk. Instead of asking how much a trade could make if you are right, ask what your position would look like if the market produces something you did not expect. A gap, a violent reversal, a failed breakout. Uncertainty does not need permission to appear. The purpose of preservation is not fear, it is continuity. You need enough capital left to make the next sound decision, and the one after that. Wealth cannot compound through opportunities you no longer have the capacity to take, but surviving long enough to build momentum creates another test. What happens when recent success convinces you that your limits have changed? Success can make discipline feel less necessary precisely when discipline has been working. After several strong trades, confidence often rises faster than evidence. You begin to feel that you are seeing the market more clearly, reacting faster, understanding more. That feeling can be useful, but it can also quietly change what you permit yourself to do. Consider a hypothetical month where your usual setups perform well. Soon, you start taking patterns you normally ignore. You trade a market you rarely study. You accept weaker confirmation because recent decisions have worked often enough to make uncertainty feel smaller. Nothing in the new trade proves that your ability has expanded. Recent success has simply made expansion feel justified. This is how growth can become drift. The process that produced the good results was narrow and repeatable. But once confidence broadens your behavior, you are no longer testing the same process. You are mixing proven decisions with new ones, then assuming the same recent success validates both. Ask yourself what exactly has improved, the method, your execution, or only the recent outcome. That distinction matters, because sustainable scaling requires evidence that the process can carry more responsibility without changing its character. The dangerous moment is not when confidence disappears. It is when confidence becomes permission. And before you increase what the strategy is asked to carry, you need a way to tell whether you are actually expanding a proven process or slowly replacing it.